April 17th, 2024. I thought bar 63 was really interesting today. It ended up being a vacuum test of the bar 19 close. Why the bar 19 close? Because the traders who bought the close of bar 19 and got trapped essentially had to scale in a whole bunch here, and you can see they were essentially getting out up here. So that's what this vacuum test was on 63. It was just a test of the close of bar 19. So rather than buying above 63, if you're buying above 63, you're hoping for a huge bull trend. And if you're hoping for that huge bull trend, I think it makes more sense to wait for follow through. We've been getting buy vacuum tests this week. You can see we had one here, one here. So, if you didn't learn your lesson over here, hopefully you learned it here. Do not trade those buy vacuums. Instead, it's a lot better to trade the failures. The failure here, or the failure here. So, generally when you think traders need one more bar, like 63, traders need another good bull bar on 64. If you think they need one more bar, it's better to either wait for that one more bar or trade the failure. So wait for the one more bar. You don't get it. Okay, you get a failure. Okay, well, you can sell 64 since it's a failure. Bar one, a bear bar with a decent close. It's towards the top of this trading range and this overall sell climax, but I would be careful because there was so much trading range price action the prior day that I didn't really want to take anything. Two, a high one after a big gap up, but I'd rather not buy. Big tail on the top, not as good as it could be. Bar three, you can see we traded down to essentially the exact low tick of two, because any trader who sold below one or sold during two was disappointed, and they might have scaled in during two, and they're getting out around break even at bar three. Bull bar three, it's an entry bar for bar two, but it's really not all that good. And a higher high double top bar four. You can see, if you're selling below one, it's counterproductive to exit above it. It's probably a trading range open, which means, bad stops are going to get run. And right where your stop loss is getting run is actually probably where you should be selling. So you can see on bar four, traders sold more above one. And we got a higher high double top on bar four. Can you sell bar four? Probably. The problem is you're selling the bottom of a tight trading range. It's maybe, I don't know, maybe 35% chance that that's the high of the day, maybe 40. I'm not super positive, but I would say best case 40% chance that it's certainly not higher than 40. Let's put it that way. That's the high of the day. I might say it might even be closer to 30. But anyways, it's a bear bar closing near its low. It's a double top. It's okay to sell. The neckline is the 2 and the 3 low, so you want good follow through below there. And 5 ends up being relatively disappointing. The doji bar. 6, again, disappointing, another doji bar, but consecutive bear closes, so 3 straight bear closes, so that's pretty good for the bears. And then you get a big surprise bar down on 7. Now, notice about 6, it's consecutive doji bars, 5 and 6, and a doji on 2, so really, bar 7 should not have happened. And traders still buy below 6 during 7, betting that this is a trading range, and there's probably going to be buyers at the moving average. And you can see during 8, bulls wanted this to be a big failure for the bears, and we get a bull bar and then follow through. But instead, what we got was an open gap. So the bulls who bought below 6, they tried to scale in during 7 and 8, and they were not able to get out. So that was the first open gap of the day. And I was, when I saw that open gap, I was immediately thinking that, well, maybe we're going to get another open gap somewhere in here. But you can see no open body gap. There's overlap of this body and that body. We weren't really, even down here, I was thinking, well, maybe this is the open gap, but no even body gap here overlapping that. So we didn't end up getting another gap until down here. You can see breakout below the 17 low, and it never got back to that price during 27. Then we had a body gap here, obviously. But I thought that this was too long in between the gaps. I thought that if we were going to get that second open gap, it probably had to form here. And if we got those 2 open gaps, then maybe this was going to be a bear trend day. And we were going to vacuum down to 5,000. But instead, rather disappointing follow through for the bears, and 18 and 19 is a big problem for the bears. So instead of that bear trend day, it ends up being a trading range day. But I thought early, if bears were even able to get an open body gap somewhere in here, that really increased the chances of a bear trend day, but they were never able to get it. So, that makes this resistance as well. And so, once we get back up to this 6 low, at some point, there'll probably be sellers there. Does that mean you need to track this exact low? Not really, because there's all sorts of support and resistance all over the chart. But it is something to note. 9, a bear bar closing near its low, but not really all that great. It could be 3 pushes down, 1, 2, 3, so not as good as it could be. 10, another doji bar. Triggers the sell below 9, but that's not really what you wanted to see. And then 11, another doji bar, so consecutive dojis again. This looks like a wedge to me, but it's a pretty tight channel down. I'm not buying above 11, but I'm expecting some sort of two legs sideways to up. And you can see the two legs we got that were sideways to up were 12 and 16. So we did get two legs sideways to up. It's just they were a lot more sideways than they were up. So generally, when you see a wedge, just reflexively, you should think two legs. At least the bull wedge like this, you should think two legs sideways to up. You get a wedge, some sort of bear wedge, you should reflexively think two legs sideways down. So when you exit, it's harder to get back in. After the first entry on like bar 13, because obviously you're expecting another leg up. So follow through on 12, but obviously it's not going to be all that great. We're touching the most recent sell climax high, the 9 high. 13, a low one short, really triggered the low one below 12. Would I sell 13? I didn't. I thought that we were finding buyers at prior day's close. We were starting to form some sort of support. And, I thought that if it was going to be a bear trend, I would have a lot of other chances to sell. So I did not sell 13. I think it was okay to. I did mark it, but I personally, I did not sell that. But it was a reversal down from the moving average, so it was okay. But the thing you have to keep in mind is we just had 3 pushes down, so you're probably going to get some sort of second leg up. So hard to want to be short. 14, big tail on the bottom, trying to form some sort of double bottom with 11, and 15, double bottom 11, but a bear bar, 3 straight bear bars, probably a minor reversal up, which we got on 16, which qualified as the second leg from this wedge. And then 17, a big dump. What's causing 17? I don't know. I mean, you could say that it's bulls selling. It's obviously a combination of both, but just trying to think about it. You could argue some sort of limit order bulls giving up. They were hoping 16 was going to close on its high and they were going to start to swing up, but instead they got disappointed. And bears, selling the close of it after 3 bars down, trying to scale in. But really, it's a surprise bar is the main thing. And we got to yesterday's low, but failed breakout of yesterday's low 17 and a bull bar closing near its high on 18. I think 18 is a good swing buy. It's a failed reversal up from yesterday's low, plus it's bar 18, and bar 16 or like really 17 to 20 is a really good window for reversals in the market. So 18 is a really strong buy, hoping that we start to get some sort of bull trend, and we get a big bull bar on 19. So when you see 19, you think, if you bought above 18, you might be thinking, oh, well, I'm going to make a bunch of money, and then you get 20. And why does 20 happen? Well, for starters, 19 is a really big bar. One of the reasons 18 is a really good trade is because your risk is relatively small. You're risking, obviously the bars are huge, but you're risking 10 points, but your reward is potentially 30 to 40 points. So pretty good risk reward, I think, for buying above 18. Except there is a tail on 18, so I think you could make an argument that it's a one pullback, 2 on some sort of lower time frame, and that the 17 high is a sell climax. So sell climax highs are going to be magnets in trading ranges, the same way that buy climax lows like this. Buy climax, the low was support. Sell climax, the high was resistance, essentially. So, this is going to be resistance tomorrow, by the way. If we get up to this spot, I would be looking for some sort of reversal down, or at least a lot of profit taking, depending, obviously, on what the day looks like. But when you see 19, the risk reward is not as good as it was just 1 bar ago. And if you bought above 18, you made a pretty good profit pretty quickly. I don't know if they probably weren't able to make 10 points, but more than 5, yeah. So you almost made 10 points, and you're right at the moving average. So a lot of traders will just exit, take their quick money, basically, because they have zero true risk because we raced straight up from the 18 high. And that's what causes 20, because traders know that a lot of times 17 is going to get a lower high because it's such a big sell climax. So we got 20. It was still okay, I thought, to look for a reversal up on 21, some sort of strong bull bar, but we don't end up getting it. We get a bear bar closing near low 21. Probably sell to close, but I think better to wait for one more bar, and then you get that one more bar, 22. I think 22 is a reasonable sell to close bar. My problem with selling it is you're selling right at the 17 close and the 18 low, which is a buy climax low, the 18 bar 18 and 19. So there's probably going to be resist support of some kind. So, I have a really tough time with 23. I think I didn't sell 22 because I literally thought, something like 23 might happen, and I was just going to have to make a really tough decision. So I just stayed out of 22. You don't have to exit above 23, but I wouldn't fault a trader for, selling 22 and exiting above 23. But regardless, just sell again 24. I thought that was a better trade because, obviously risk becomes smaller. You put your stop above 24 since it now creates that lower high. 24 is a lower high, right? So we have this and then pull back and then lower high 24. So definitely a good sell 24. Good follow through 25. Big tail. We're getting pretty far from the moving average, and you can see we are essentially at the channel line. but I still think okay to be short since it's clearly always in short. And then you get 26, some sort of wedge, maybe 9, 17, 25. I think traders will exit above 26. And you get bull follow through 27. At this point, I think the bulls need something pretty clear for me to want to buy. I'm just looking to sell pullbacks. You can see it's a bull channel, so you're going to have a tougher time selling lows and a better time selling pullbacks. So 26, 27, follow through for the bears. You can see that if you sold below 24 and those traders, they put a stop at break even and they got stopped out. So you don't want to be trading with break even stops, especially in trading ranges, and a bear channel is the type of trading range. But you can see when we got back to that 24 low during 27, traders sold it again. So we got another leg down 28, a pullback 29, but I think this just looks like one pullback 2. So it looks like a 2-legged correction to me. And then 30, a low 2 short. Can you sell 30? Yeah, it's just lower probability because it's a really small bar. I personally would wait for follow through like 31, but sell to close 31. You are selling near the channel line, so that's the only problem. Follow through 32, and then disappointment 33. I would get out above 33 if it triggers, but you can see it doesn't. 34, so 34 low 1, traders can sell. Outside down 35. You should not be selling below 34, stop above 34. I think once I saw 33, I put my stop above 33. I think traders put stops above 33. And then, you can sell more 34 or initially take your first sell 34 with a stop above 33. 35, like I said, outside down, and then doji follow through 36. At this point, everybody knows that the bears are going to exit above any sort of bull bar at this point. So traders are starting to get pretty cautious, and all those traders, the bears are selling pretty much on all these closes, trying to stop a bull close from happening because they know any bull close, bears are just going to get out. So they want to drive the market down as long as possible and try and get a vacuum test of 5,000 essentially. 37 triggers the low one below 36. Not really the best sell below 36. I think we're probably going to bounce pretty soon. 38 bear bar, big tail on the bottom. Again, it's pretty sketchy to be short down here, but you definitely can be. And then outside down 39, climactic bar at the bottom of a range or at the bottom of the channel, 60% chance it's the end of the trend, 60% chance you get one more leg sideways to down. I think at this point, what do bears want at this point? What's your goal if you're still short after 39? Well, you're hoping this trend's going to get a lot stronger and we're just going to get basically a giant vacuum test of 5,000. So, I don't know, maybe 30, 40% chance of that, maybe probably closer to 30 of just all the way to 5,000. But either way, this is probably the end of the trend, most likely. And then you get 40, a big reversal up. Bears are going to exit, bulls can buy. It's okay to buy above 40, midday reversal. I thought the bear channel was relatively tight. So what's probably going to happen first? We're probably going to get another leg sideways down like we did on 42. We ended up getting a steeper rally than I thought we would, or I was kind of hoping we were going to go a bit more sideways first because I was looking to buy down here. But what happens is when a lot of traders are hoping the market's going to go a little bit sideways first, they start to establish a position, and then the market just ends up going without a convincing pullback, which happens relatively often. So 41, low 1 short, not very good, probably buyers below. You can see there were buyers below 41 and disappointing follow through 42. Bull bar closing near its high on 43. It's probably by the close. It's probably always in long. Follow through 44, but not able to close above the moving average. So problem for the bulls. And then 45, doji bar. At this point, I think traders are hoping we get a pullback and then a reversal up, but it's just less likely, or it's not super likely that we get a very clean reversal up. I don't think. 46 follow through for the bulls, and then disappointment 47. 48 outside up. I wouldn't sell 47. It's a low 2 in a really tight bull channel. After 4 straight bull bars, probably buyers below. Outside up 48. I think 48 is an okay buy. It's a really tight bull channel, and we might just get some sort of vacuum test of like the 19 high. I thought we were going to the 19 high when we got this reversal, but I was just looking for a reasonable entry. And I didn't make any money I made no money during this. I actually lost a little bit of money. I bought about 48 and I got stopped out. I just exited somewhere in here. But there's a prime example of I was pretty sure we were going up here and I didn't make any money on it. And that's trading. You're a lot of times going to know what the market's going to do, and you're going to try and trade it, and you're going to lose money, and then it's going to do what you thought it was going to do. And that's kind of just part of the process. But that's fine because that's good chart reading to know where the market's going. But trading and chart reading are different skills, and so you have to you can be a really good chart reader, but doesn't mean you're a good trader. So those are different skills, and you have to develop the chart reading skill before you develop the trading skill. But anyways, 48 I thought is a good buy. It might be 3 pushes up, 1 pullback, 2 pullback, 3, and the 30 high is potentially the start of a trading range. This was a potential final flag, so we might be somewhere in here. But I thought okay to buy about 48, taking a chance. And then you get disappointment 49. Traders will exit below 49 if we trade below it. They were hoping that on 50, traders were going to buy the close and we were going to get a big bull bar closing near its high. But instead, we found sellers up there. And really what you wanted to see was 50 close above the 48 high, since that was traders' entries price. And you wanted to see them not selling out of their longs, but instead they do. And then you get disappointment 51, a second entry up 52. Do you buy above 52? You probably can, but it's a tight trading range, so kind of difficult. And when you have a difficult decision like that, what do traders do? They buy the 50% pullback. You can see 52, they bought 50% pullback. I hadn't looked at this yet, but I assume, yeah, look at that. The 50% pullback of bar 40 is where 42 went to. Why? Because when the risk is big and the trade isn't as clear as they want it, a lot of traders will try to get a better trader's equation. That's exactly what happened on 52. And because the trade, I don't think 52 was as clear, so traders wanted the discount. And 40, I think that it was a big bar, big risk. Traders knew probably one more leg sideways down, so they thought that the 50% pullback was a logical place to buy. Followed through 53, 54, 55, but ask yourself, what does this look like, 52 through 55? Does this look like a really strong bull trend to you? Not really. If you're buying, you're hoping it's going to become a strong bull trend, and at that point, I would just wait for it to do so. 56, an inside bar. I think bulls exit below 56. Fall through 57, but it's not really all that good. Probably sideways. This is 3 pushes up, right? 46, 50, and 54. So probably expect a couple legs sideways to down relatively soon here. Again, 2 legs sideways down, and 58 could be the start of that. 59, an inside bar. You can see buyers below. 57 during 59. 60, big tail on top. This is just a tight trading range. I'd wait for a breakout. Same 61, tight trading range. I'd wait for a breakout. It could be a few legs down. 62, a bull bar closing near its high. Sorry, not near its high, but easily above its midpoint. It's a high too, but you're buying in the middle of a tight trading range. I would not take it. And then you get a big surprise bar, 63. Oh well, I think that 63, you're just going to miss the trade and have it be what it is. If 64 is another big bull bar, great, you can buy higher. But I think 63 looks a lot more like a trap and a leg in a trading range than any sort of bull trend. Might be a second leg trap, equidistant height. No, not quite. Okay, never mind. Sometimes you get leg 1, leg 2s that form like that, where it's leg 1, pullback, and leg 2 is the size of the climax. 64, great sell, failed bull breakout of essentially this whole thing. And okay for a swing sell. This is a tight trading range, and we're probably going to come back into the middle of the tight trading range since it's a magnet. And that's what happened on 65, back into the middle of the tight trading range. 65, I think tough. If you're short, probably take a piece off since you made a bunch of money from basically bar 65 on its own. You made a pretty big profit. So I think okay to take a piece off and look to get out above any bull bar. The problem with staying short is that your risk is really big. 66, a doji bar, but this is getting difficult. I think if you're short, the problem is your risk is really big. So you have to find a way to get out probably a couple points above 66. And then once 67 trades below 66, I think your stop can just go above 66. Once 67 goes below 66, because if we go outside up here, I wouldn't want to be short. Fall through 67, 68, 69, 68 doji bar, probably more of a trading range bar, or it is a trading range bar, meaning that we're probably about to start developing into a trading range since in a sell to close rally, when you get a doji bar, it means that the sell to close, excuse me, it means that the sell to close is most likely coming to an end. So again, I would probably just get out directly above 69, and that's probably why we got a decent bounce above 69 during 70. Bears exiting, and at that point in the day, I would just be done. I don't see any reason to keep trading, and definitely there was no other credible trades. For trades on the day, I thought if you could sell below 4 if you wanted to. You could sell 13 if you wanted to. I thought the first good trade was probably 24. I thought 23 was fine. 30 is fine. It's just low probability, but go for it. 31, sure. 34, sure. And I would not sell 39. If you have a remaining balance that's short on 39, maybe you can take a piece off and just exit the rest above 40, but I wouldn't initiate a short there. It's okay to hold a piece and hope we go a lot shorter, a lot lower, but I think all the bears exit above 40, okay to buy above 40. Excuse me. You could probably buy 43 if you wanted to, 48, maybe 52. I wouldn't personally. And then sell 64, maybe 65, 67. On the daily chart, you know, bears are getting decent follow through here. We have 4 straight bear bars. 1 second. We have 4 straight bear bars, and we are going to 5,000. The question is if we go straight there. If we get any sort of reversal up, it's probably going to be minor. I think bulls have missed their chance for some sort of trap. This is pretty steep, and we're forming a surprisingly wide trading range. I thought we were going to form a trading range a little bit more up here, but then we got this. So the trading range might be from 5,000 to wherever, maybe this low, right? Do we get back up here? I don't know. I think it'll be a while for sure. This is a strong enough trend that I don't think we're just going to turn into some big bear trend. I need more evidence, but if we can continue to get big bear closes, that could be the evidence necessary. The reason that I don't think that this is going to turn into a big bear trend is the monthly chart. If you look at it, what does this bar look like to you? It's a disappointing bar for sure, and you think that we're probably going to get at least a couple legs sideways to down, but overall, you expect this to be a minor reversal after this much of a buy climax. So that's basically my thoughts on that. On the weekly chart, like I said, late last week, there's a chance that we vacuumed around 5,000. It wasn't very likely, but it looks like we're probably going to get it. The next, I don't know, the next high, the next gap is probably here, somewhere in here. But I think we're going to find support at the moving average and probably start to go sideways pretty soon here. Yeah, that's today.